Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today on this last minute live stream.
Elijah, isn't it fun? I mean, we've known each other since what, like 2013? I mean, you were like in high school when we met, I think, weren't you? And now, I mean, after all these years of wandering in the desert, we are finally reaching the promised land.
Good analogy there. Yeah, no, it's been a fun ride here over the last decade or so, but we're finally breaking $41 silver, gold all-time highs at 35.50 and above. What is happening today?
Well, there's a number of things that are combining. A big picture, right? We had a 25% year in gold last year, which was the third time, maybe fourth time this century that that's happened. Every year that has followed a 25% year has been, I think the best we've done is 10. Sometimes just give a part of it right back. So the fact that at least here we are in September and we've already tacked on another 30% should be an alarm bell for everybody. And the proper way to look at this is not that gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. Uh, we talked 10 years ago, Elijah, it took 1,500, Federal Reserve notes, or what, 1,200 back at the bottom, 1,100 Federal Reserve notes to buy an ounce of gold. And then what, 5 years ago, it was 2,200. And now it's 3,500. It's the gold's not changing. It's how many dollars it takes to acquire it that's changing. Lastly, what you're seeing even today is the price has been steadily moving upward over the last 2 years. And it breaks out, it surges 15%, it consolidates for another 3, 4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce.
And it is interesting to see also trouble in the bond market worldwide. We've been seeing, talked with Andy Scheckman yesterday about this, the UK bond market, and also in the US bond yields rising and on the 30-year Treasury. Your take on that? And is this kind of, I guess, my take could be kind of like a lot of people are losing confidence in the dollar, and this is a clear sign because they're not wanting US dollars, they're not wanting debt, and they're not even wanting other paper currencies out
Right.
there as well. Your take on what's happening?
Right. That's the deception of the dollar index because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index and it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. I wrote, Elijah, do you remember when we do this often enough? I'm sure we did a call like this back in January after I published my yearly forecast. Do you remember doing that?
Yes, yeah, definitely.
Okay. Um, I had a line in there. I was just reminding people on my site this morning. That was almost kind of like a throwaway line. You're like, yeah, right. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control, but now all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the US. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before. which is why I wrote about it in my pod. I even put a link in there in that macrocast because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I mean, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so, if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
It is crazy because the Fed is really trapped here because if they continue to raise interest rates, that is bad for the economy. And we're already seeing bond yields rise. But really, if they do modern monetary theory, right, you mentioned how that's extremely bullish for precious metals, but that's just going to hurt the middle class even more,
Sure.
given that, prices are likely going to increase significantly due to that.
No doubt. I mean, it's just kind of the end game of what was begun in 1971. There's a chart or a website that maybe people watching have been to before. It's run by the Federal Reserve Bank of St. Louis. Fred charts. You can just Google Fred charts and it'll take you there. And you can find all kinds of economic. I mean, it's a research site. Yeah, and there are so many wealth inequality, income inequality, the purchasing power of the dollar. Everything changed in 1971. Well, what changed in 1971, Elijah? That's when we went to these free floating exchange rates with currency backed by nothing. And all it has done is make declining standards of living for a greater percentage of the population. Now, if you've got assets, if you've got the cash and you've got the assets, then you benefited. Your house has gone up in value or maybe stayed ahead of inflation. The stock market has gone up, your 401k. But if you're, the great percentage of people out there that don't even have $500 in savings, this has not benefited you at all. It's only making things worse. But this yield curve control is coming, Elijah. I'll remind you of something from the COVID days. You remember, I think it was March, it was Monday morning. I think it was the 12th of March in 2020 when the Fed cut rates to zero, emergency rate cuts from like 150 basis point on Fed funds to zero. And they announced this like laundry list of acronyms of we're going to do this program and that program and this program and that program. And one of them in there was they were going to start buying corporate bonds or corporate bond ETFs maybe. And everybody freaked out, like, what? How can the Fed be buying? Of course, now 5 years later, the Treasury's taken a position in Intel. But anyway, that notwithstanding, they said they were going to do this. They didn't actually do it until they kind of dabbled about a year and a half later. Just the notion that they would buy corporate bonds put a bid under the corporate bond market, as we're entering a recession with COVID and all that kind of stuff. And I think that's what they'd initially do with yield curve control. If the Fed comes out and says, we can't have the long end running away from us, all this kind of stuff. So the Treasury will be a buyer of, all long bonds above 4% or all 10-year notes above 3%. Well, then heck, if you're, a hedge fund or pension fund or an insurance company or something, and you're worried about duration risk and the Fed's got your back, well, then all of a sudden buyers emerge for that paper. And the Fed didn't have to do anything. So that's the type of yield curve that control is probably coming, and then it'll probably have to be active after that. Either way, it's again, if I'm right about this, you ain't seen nothing yet.
We have a viewer's question here about platinum. They believe this viewer wants to know if you think that platinum is still the best value at the moment, given obviously its ratio to gold and even silver being incredibly a huge anomaly right now and incredibly undervalued historically compared to those metals. And just another side point as well that maybe we can cover as well. Silver and platinum mentioning platinum here, silver and platinum were recently classified as critical metals by the U.S. government. So that I think is a story in and of itself. But your take on platinum at the moment, as we're not seeing it increase as significantly in these last few days.
I love it. The first question we get is a metal that I really don't follow very closely. And I never have. But I do know, I mean, there's been a lot of talk about platinum lately and lease rates in London indicating maybe some short supply of physical platinum. We got a lot of platinum and palladium comes from South Africa and Russia and places that aren't necessarily dependable suppliers. Platinum has moved up already about 40%, like silver has year to date. So that, that the idea that I mean, it's still up pretty good the last couple of days, but I don't know. Again, other than that, I don't have a lot of comment on it because I don't own a single ounce and I don't want to make it sound like I've got some idea what I'm talking about. Regarding the critical metals thing, that's important. Um, for a number of reasons. You could say, well, it might increase the supply, right? Eventually, if the US government is going to be subsidizing mining operations, but I don't know. I mean, it's interesting it's on the list. There were 10 or 11 that were listed as extreme risks. And it's a whole bunch of, eums and unums that you've never heard of before. Maybe the only one that anybody's ever heard of is tungsten. I didn't, the US doesn't produce a single ounce of tungsten. None. Like China produces 90%. US doesn't produce any. And that's a critical. I use that as an example of where they listed critical. They listed silver and platinum and a whole bunch of others as an elevated risk. So it's noteworthy. I'm not sure if it has had an impact over the last few days, other than getting people to go, "Oh, well, that's interesting." Um, I think more interesting regarding silver is just it's just the fact that it's $42. I mean, that's pretty rarefied air, and sustaining at this level, at least for now. That's probably the most significant development.
I was just talking to Peter Grandich, and I know Tavi Costa has done a lot of work. We shared his chart on the show about that cup and handle formation
Hmm.
that 30, 40 year or 40, I guess almost 50 year cup and handle formation from
Yeah,
1980 highs, connecting that to the 2011 highs, and then that handle we've had over the last 15 years or so. One of the kind of the biggest cup and handle anyone has ever seen, and these very, very often resolve to the upside. So, I mean, if we look to the end of the year, I'm talking to Michael Oliver, for example, saying that silver could very quickly go past $50, $60, $70 potentially. Maybe early next year as well. But your take on where we could see silver go, it's not unprecedented for silver to make very fast, very large moves very quickly, like in 2011 when we saw silver go from $30 to $50 in a matter of 2 months or so. So
yeah.
what is your take on where we could be at the end of the year?
Well, I'm not in that crazy breakout camp just yet. Um, I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the commitment of traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the commitment of traders reports. Um, and that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those commitment of traders reports. Because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then when we get that breakout of, top top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before. It's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer's right here, but if I push it, okay, all right, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the 48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is in this current move is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50 and then start making new highs after that, well, then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year.
Are there any, I guess, unusual developments you're seeing, for example, in the COMEX? I mean, we're hearing about a lot of deliveries on COMEX and a lot of volume there. What is your take on what's happening right now?
Well, I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if you're long and somebody the short puts the silver to you. And, historically, that's a lot. But back in March and May, we were doing 15, 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. I don't, to me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this. We're like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager. They'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery Stan. You can't take delivery Ray. Okay, well, there was this news last week. It looked like the Saudi whatever sovereign wealth fund had bought $1 billion worth of the SLV. Did you see that? Um, well, I thought that was interesting. Now maybe they're just playing the same, we just want price exposure and liquidity game like Druckenmiller. Maybe they wanted the silver and maybe they were told we don't have that much to deliver if you ask for it. here in the city of London, we can't ship that to you on a timely basis. Would you please just buy this instead? So it'll be like I said, I don't think I mean everybody gets all excited about the COMEX and will the COMEX fail? I think your delivery stress is going to be found, if the house of cards start to collapse, it's going to emanate from London or it's going to emanate from one of these unallocated pool accounts things that some places run, that could set off almost like a little mini bank run. I'd say that's more important.
Well, it should be quite exciting to see where we go from here. Exciting day in the markets. Thank you so much for doing this last minute live stream, Craig. If our viewers are interested in learning more, they can go to tfmetalsreport.com. What will they find there?
This is what I do every day and have for the last 15 years. We watch these markets like crazy. I've had a lot of people in the last week, a lot of old subscribers, email me and say, "Hey, thank you for, sticking with it all these years. It was pretty lonely 10 years ago and all that stuff." And I've just always said, Elijah, look, this isn't rocket science. The math is the math. Brent Johnson, my friend, Santiago, gold guy, milkshake guy, always had the line that he said, if you believe in math, then you need to own gold because the math. I mean, there's always going to be the end game, this devaluation of the dollar and everything else. And so that's what we do here. I write about it every day. I talk about it every day, keep everybody up to speed. And I just encourage everybody to check us out, but also understand uh, where this is headed. Um, there's always a temptation to say, oh, wow, this has moved so fast, and markets are never going to go straight up. Um, but like I said at the beginning, if I'm right about where this is headed later this year and into next year, and I think they're telegraphing that, you ain't seen nothing yet. So hang in there and keep your wits about you.
Well, Craig, once again, thank you so much for your time today. You have a good day and God bless. Again, the interview, the link to go to is tfmetalsreport.com. We'll put that in the description here and also our number if you want to call us to order gold or silver. So thank you so much, Craig.
You too, Elijah. Good to see you, my friend.